So the purpose of this panel is to give you a kind of an overview of the movement calling for investors to divest from fossil fuels and the opportunities and urgency of investing in climate solutions. And I want to begin by thanking the Alliance. Obviously, the Alliance has played a major role in convening the series of events over the last couple of days, but I want to give a particular reason why I think this has been so crucial. The Alliance also has allowed the leadership of the divestment movement to come together this week and have a series of meetings and opportunities to share ideas and strategize, and it's been extraordinarily helpful. So you have a really creative group of folks in this room who've been doing a lot of the work that's made this issue rise up onto our screens, our collective screens. So I am going to spend a few minutes setting a context for the discussion about the divestment movement. And then we have 4 fantastic panelists. And I'm not just saying that because that's my job to say that, but I know each and every one of them, and they are amazing human beings and are all going to provide a rich information for this discussion. But I'll give a little bit of a context for the movement. Many of you were at the event last night, so I might be a little bit redundant for those that were there, but for those that were not, I just want to talk a bit about the reasons why this movement have exploded and why we're having this discussion. Its history, it began barely 4 years ago, and it's exploded from a handful of campus campaigns to now being a full-blown global movement with activism and commitments towards divestment occurring all over the world, spreading from universities to hospitals, faith groups, foundations, pension funds, cities, individuals of high net worth, individual retirement accounts, and it's risen to the level of high-level financial discussions and policy discussions, and is increasingly an issue that I think most institutional investors are facing in terms of determining their position towards the issue, whether it's for ethical reasons or financial reasons. So really, where did this begin? And I can give you this perspective, and tell me if my mic's okay. Is it working? And is it too loud? Okay. I can give you the perspective because my foundation has been involved in the movement really from the beginning. So we're clearly advocates for the importance of this movement. And we also, as an investor, committed to divesting our funds from fossil fuels and investing in climate solutions.
By the way, that should be your pause for the clap.
Oh, yeah. Okay. And for another clap, we're 100% fossil fuel free. We're over 10% investing in climate solutions, and we're doing extraordinarily well in the market. So, thanks to actually a few people on this stage. So 4 years ago, very pessimistic. Copenhagen talks basically reached no agreement, and the US Senate climate bill collapsed. And the environmental advocacy community was despondent. It just seemed impossible. We had poured millions of dollars into advocacy. We had poured millions of dollars into promoting the science, because, you know, it's science, should change minds, and poured money into supporting advocacy campaigns, very sophisticated advocacy campaigns. However, the industry itself was pouring lots more money into denying that science and making sure that politicians were clear about who their donors were, and it just seemed like it would be impossible to get a deal. And into that vacuum stepped a student movement campaign that began calling on their universities to divest from fossil fuels. Many of the campaigns are also calling for their universities to invest in climate solutions. In early June 2011, the first group of organizations came together and hammered out a campaign. It spread quickly to dozens of campuses, and then in an absolutely historic moment, an article was published in Rolling Stone magazine, penned by renowned environmental activist Bill McKibben, who cited the brilliant work of the organization Carbon Tracker Initiative, who Mark will represent in a moment, that laid out the notion of the carbon bubble and the stranded asset risks of the reserves that fossil fuel companies are holding. And I'm not going to go into detail because Mark will do that. But the publishing of this article took the slowly bubbling up divestment campaign and put it on steroids. And overnight, there were 400 campaigns on college campuses, and the brilliant support that 350 staff and all of the organizations that work with 350 took this campaign viral. But what's remarkable is that while this is a student campaign initially, it spread rapidly to other sectors. Faith communities began saying, look, we have to look at this. This is right. This is the moral and ethical place to be. And because of the arguments of the financial risks, it also spread quickly in the financial sector. And I would just end with my introductory comments by saying three things, and I mentioned this last night, that this movement has been compared to previous movements, perhaps most notably the anti-apartheid movement. And looking around this room and also knowing a lot of the folks in the socially responsible investment community cut their own teeth in the anti-apartheid movement, I think it's important to highlight why this movement is actually different. There are similarities, but what's different is, and probably the reason why it has grown so rapidly, is that in this case, the ethical and financial arguments are aligned. That the risks to the investment portfolio aren't just ethical. The reason to look at this issue is not just a moral one, and indeed it is a moral one, and it is an ethical one, but that also the stocks are risky to retain in your portfolio. And in fact, many of the investors that got out of fossil coal and oil over the last few years have done quite well as a result of doing that. So the ethical and the financial are aligned. The second reason this movement is different and gaining traction is it's not just saying let's stop the bad, but actually we have a dramatic role to play in capitalizing the transition to a new energy economy. And in fact, we both have opportunity and perhaps responsibility to scaling up that new energy economy rapidly. And then the third reason that it's different is it's actually not so hard to do. So I mentioned this last night, that during the apartheid years, the campaign called for divestment from companies that comprised about 40% of the S&P, and this is about 7 or 8%. So it's not a heavy lift for implementing this, even in complex investment portfolios. The fact that they're that complex might be a challenge, but it might be a challenge you should be looking at for other reasons. So not a hard lift to actually implement a commitment to divestment. So I'll stop there. I just wanted to give a little bit of a landscape. And what I'm going to do, and hopefully will do well, is introduce each panelist, but introduce them with a question and ask them to respond to a question. So I'm going to turn first to Mark Campanale, who's sitting on my right. And he is the founder, and no one's sitting on my left, so that was obvious. He is the founder of the Carbon Tracker Initiative and the Social Stock Exchange. And he has a lengthy bio that you have in front of you. But what I will say that is not in his bio is that I believe that Mark's thinking and conceptualization will go down literally in history as being one of the most disruptive concepts that change the face of the debate on climate change. So, Mark, I'm going to begin with a question.
Thank you.
That wasn't the question, that was the compliment. So, Mark, can you talk a little bit about the carbon bubble and the notion of stranded asset risks and why there is a financial case to look at the risks in your portfolio from carbon assets?
Okay, great. Thanks for inviting me to speak. So my background's traditionally in fund management, long-only equities. I was doing that for around 20 years in the City of London. And what I noticed is so many coal and oil companies coming onto the London market at a time when the climate science would be saying a lot of these businesses models were being challenged. And I worked in an institution because it was a big index investor as well as an active investor. Every one of these coal companies that were coming onto the market would buy, write checks for tens of millions for this. And one of the question that was on my mind and my colleague Nick, who co-founded Carbon Tracker with me, was somebody has to have added up all the reserves owned by the world's top 200 coal and gas companies and converted into carbon dioxide. And so for about 3 or 4 years, we went around looking for the person who'd done it, because it's such, in a way, if you think about it, it's a very obvious question. And then we realized maybe somebody hadn't done it. And so I then created Carbon Tracker to answer that question, and we found a philanthropist. Anybody you hear involved in philanthropy, it took me 2 years to raise £3,000 to launch Carbon Tracker. And I found one philanthropist called Jamie who said, we'll have a go with this idea. Bless him, because I couldn't have got the thing launched without Jamie and putting a small team together to go away and do the maths. We have an S in maths, I don't know what's going on here. And so we went away and we found the answer to the question. We found the answer to the question, which was that, just give you the numbers again, is that if you're familiar with the industry, reserves are where you have a 90% probability of extraction for coal, oil, and gas. And that's different to resources, which is where you will own a license to explore. You're fairly certain you know what you've got. And we looked at both resources and reserves. And we then tested it against the climate science of how much can you release. A lot of the science is already out there, the IPCC. You can release somewhere between 565 and 1,000 gigatons of CO2 into the atmosphere before you really get yourself a problem in terms of warming. And once you've added reserves and resources of just the top 200, so not all of them, just the top 200, it takes you to somewhere around 1,500 gigatons. And so the difference between that and the budget, that's what the carbon bubble is. Now, what we didn't say is that it's a financial bubble. So that's the first part of the question. We said there's financial risks here that need to be understood. You need to go away and analyze it, and you need to work out what does this mean for your business. So when I look at divestment, we look at it in 3 ways, and I just want you to sort of think about it a little bit. So people probably think that when we call for divestment, it means selling the stock in a company, which is what probably most people have got thinking about. But from how we look at it, there's 2 other types of divestment. The first is actually changing stock markets and the way you manage stock markets. So you actually divest all stock exchanges of the fossil fuels that take you above a 2 degrees carbon budget. And that's why in our first report, we talked about the role of financial market regulators. And there's only 2 markets that count. So if you go back to our first report, unburnable carbon, other markets carrying a carbon bubble, most of the coal and the oil and the gas is listed between London and New York. So what we said is that if you want to have some kind of accelerated climate deal, you need to involve the financial regulators, with the SEC, with the regulators in Europe, because actually there's a regulatory approach to this issue. So we have letters written into the SEC. I know Ceres, our colleagues from Ceres have written into the SEC actually saying, if you're a coal company and you're raising money and the company's already listed can't burn what they have, every time you file a prospectus that says, I'm raising $500 million to do a coal project or an oil project, and you can't sell or burn those resources, when you're raising that money, in what way is that not kind of a form of fraudulent misrepresentation? Because if you have to think about it. So what we're saying to the financial regulators, and we've had great success with the Bank of England, with the Governor Mark Carney using our unburnable carbon, is you need to look at the risks from you as an investment bank raising capital for a coal and oil project or a gas project, and there's a regulatory question. So let's divest exchanges from the excess carbon. So divest from at a stock exchange level. So the other areas obviously sell at the portfolio. So there are risks, and coal is the obvious one. And if you go onto carbontracker.org's website, you can download the report we published a couple of weeks ago on the US coal industry and the prospects for the US coal. And everyone, I think, knows the numbers. The coal is off in aggregate about 70% the last 3 or 4 years. So there's clearly a financial case there. Oil's a little bit more tricky. It's a little bit more tricky. It's a slightly different industry. Well, it's a very different industry. And here, what we talk about is divestment at the project level. So when you think about an oil company, let's just take a hypothetical one. They've got 20 projects, and the 20 projects are continually running out because obviously you sell a barrel of oil, you're depleting your reserves. And what they're doing is the cash that they make from those projects, they're punting it forward into new projects. Okay? And it's called the reserves replacement ratio. They're replacing barrels of oil sold. That's what they do. So the economics of the industry is changing. You're having to go to the Arctic. You're having to go to ultra-deep sea water to find your oil. It's becoming more and more expensive. So this is what we're discovering in our oil carbon cost curves reports, is that previously companies like Chevron and Exxon were finding and making money from oil. It was costing them $20 a barrel to produce. Actually, when you look at all these new projects, they require the price of oil to be above typically $95 a barrel to get an economic return. And where is the price of oil today? I think where is it? Something like $55, $60 a barrel? So how does it make financial sense for these companies to use shareholder funds to prospect for oil that costs them $95 to produce when the oil price is 60? But that's what they're going around telling Wall Street. And here's the dirty little secret of the oil industry, is a lot of these companies are funding their dividends not from the money they're making, they're funding it from borrowing. They're not even making any money. And yet we're told that we have to hold these companies as core parts of the index, and we have to hold them in the portfolio. So what Carbon Tracker's analysis, and part of the work of the Carbon Asset Risk Working Group of Ceres and others working together, institutional investors working together, is to go to Chevron and Exxon and actually say, don't do these projects. Divest yourself from these projects. And I want to finish on this point, is that if you were to think of these oil companies as in runoff, they're running off their barrels of oil, they're selling them, and they're running off. There actually will be a cutoff point when we get to 2 degrees beyond which they can't sell another barrel of oil or a ton of coal. If we put these companies into runoff today, instead of investing these funds into new projects, they could be cashing it out. So what we're saying to the companies is, don't do new projects, cash it all out, double the dividend. And here's one of the questions which I'm trying to get my colleagues at Carbon Tracker to answer is what is the total future value of dividends paid by the coal, oil, and gas industry in the next 10 years? Do we know the answer to that question? I suspect that it's certainly going to be in the hundreds of billions. We often asked, where's the capital going to come from to fund the clean energy revolution? I know where it's going to come from. It's going to come from closing down and running off the oil companies. That's where it's going to come from, dividending themselves out and managing a decline out. And that will fund the clean trillion that we need to fund the low carbon economy. And if we get this one right, we'll have an orderly transition out, a soft landing. And there won't be a financial crisis. But we have to choose to get this right. And that means controlling the corporations that should be run on our behalf. And that's why the corporate governance question, who really controls these boards, is a central question to the divestment movement, is who holds these people to account? Why do we put up our own candidates to run these companies down? Why do we have to have guys running them to say we just want to do more and more and more? Well, actually, if it's a failing business, you replace the directors. And that's really the next direction, I think, where this movement will have to start looking.
Well. So I'm going to turn next to Jerry Watson, and I'll set just a quick context. Within the philanthropic community, there's been a very strong movement to commit to divestment and investment in climate solutions. And part of the powerful motivation is that philanthropic institutions are charitable institutions and serve the public good. And many foundations have committed to move to a position of divestment so that our investments and our grants are aligned, or our investments are not undercutting or driving problems that our grants are used to solve. I say that from the perspective of my foundation, and also because we helped establish Divest Invest Philanthropy. And to date, there's 90 foundations worldwide that have committed to divest and invest. But perhaps the only foundation that is known for committing to divest and invest, perhaps more than they had wished, is the Rockefeller Brothers Fund, who in September, in advance of Ban Ki-moon's climate summit, led a cohort of about 55 foundations to make their commitment. And we are privileged to have Geraldine Watson, who is the Vice President for Finance and Operations at the Rockefeller Brothers Fund, who orchestrated a very complex transition in their investment portfolio, and still is. And I will start out with a question, a really simple question. What inspired RBF to join Divest Invest Philanthropy, and why did your institution think this is important?
What inspired us? The woman to the left. No. Ellen has, as we all know, she's been such a catalyst, and she was very patient with the Rockefeller Brothers Fund, because we had to, one, come to our own thoughtful conclusion, and also had to get our house in order for us to make the steps that we wanted to. But I'll give a little bit of a background, too, that leads to the inspiration. And a caveat that any of the remarks I make are in the role that I play at the Rockefeller Brothers Fund, which our board does have approximately half of the board are family members, the other half are not. But the Rockefeller Brothers actions do not indicate that it's the entire family or the other Rockefeller affiliates. So we only speak of our own commitment and our own inspiration and rationale and process. But the family as a whole, though, has been interested in the environment and in social issues since the inception of their philanthropic work. And for the Rockefeller Brothers Fund, we'll be celebrating our 75th anniversary this year. We came a little bit later than that 75 years to really start to try and use the full power of our assets to support our mission. And in 2005, the first step that we took was trying to, and through about a year-long process, developing very strategic proxy voting guidelines, which we then had all of our managers adhere to, and at the time we used ISS to exercise those rights for us and report to us. So that was the first tool that we were starting to use to expand the power of our investments. We then, just a quick snippet, which is very critical, though, to the story, in late 2007, we outsourced our investment portfolio to a terrific investment firm, which had a commingled business model, which this morning we did hear that commingled business models aren't necessarily a total barrier, but in this particular case, it was a serious challenge because we didn't just have our own commingled models of funds, we actually shared them with 13 other clients. So whatever influence we wanted to do, or discretion or direction we wanted those funds to have, we couldn't just direct the OCIO to follow our lead. We actually would have had to get all 14 clients on the same page. And although we did try that for a period of time, we did realize that that was not really going to be successful. So while we were still there, because we were very pleased with the partnership other than that, and it was due to the model, we wanted to try and find other ways that we could, again, use our assets to support our mission. And the board in 2010 committed up to 10% of the portfolio to proactive impact investing. Initially, the easy wins were thought to be in the renewable energy field, and that made perfect sense for us since across all of our program areas, we have a climate change program area, but many of our other areas are also working on climate issues. So approximately 50% of our grant dollars are going to battling climate change, and I'm not going to discuss the science. Everyone here is a believer in it, as they should be. But so this, we thought, would be a way that we could, again, use our assets, since we had lost the proxy voting guidelines, right, also with this commingled business structure. So that was in 2010. And then between the period of 2010 and 13, as we were hoping to make progress with this 10%, the conversation broadened. We started to realize that with all, as I said, 50% of our grant making and much effort and interest in combating climate change, our investments in many cases were directly undermining every grant dollar we made. More than that many dollars were being given to investments that were going totally contrary to what we were hoping for. So that created another discussion, which actually then led to a mutual decision between ourselves and the firm that we were using, that again, this 14-client business model of commingled funds would not allow us to have any discretion to direct that we would not want certain assets in or investments in the portfolio. So in 2013, we then made the leap to try and extricate ourselves out of there and ended up with a phenomenal firm. And you heard Christy Zarkovich this morning, Perella Weinberg. They've been with us, working with us about 15 months. We've aged them tremendously, and it's been a fantastic journey. We're very pleased with the progress. So that's the story, and then I'll go back to that in a minute. But as far as the inspiration, it takes leadership from our trustees. Most importantly, though, even prior to that, you need a president that's passionate about this. It's not an easy discussion to start. You need to get your investment committee on board. We were able to do that partly because, one, we have a committee that is fantastic. They're all Wall Street types, but they view the Rockefeller Brothers Fund almost as a client. And if the client wants to do this with their investments, we need to help them find ways to do this strategically, but also maintain our other objective, because besides aligning with our mission, like many of you, we need to maintain the purchasing power of the dollar of the endowment. So it's a balance. But really the inspiration was, how could we possibly not want 95% of our dollars support the most important work of the 5% of the dollars? So that's really where it was. And then with Ellen's urging over the period of time for about 2 years, as we had to go through this realization and then make this transition, last February and then June was when we really decided that with September, with the UN meeting and the Peace March, we needed to be able to take a stand. And what would that stand be, and how could we do it? And we wanted to make sure that we studied it well, so that when we came out in September, and I was so proud of our president, Stephen Heinz, in making that announcement, but we wanted to make sure we were speaking truthfully and also wisely as to the path ahead. We all know when institutions make broad claims that then 2 or 3 years later don't hold any water, that actually does more damage than it may have done the good. So as you likely know, we committed to the divestment process. And at that time in September, we were pleased to say that our coal and tar sands, which we felt were the most offensive, were less than 1%. Our total fossil fuel was less than 5%. We know both of those have decreased since then. And one might ask, well, why aren't you at 0 now? This is however many months later, 6. But again, we are balancing. And we said then in our statement, because we wanted to be honest, we would do it gradually and strategically. And as Christy actually alluded to, she didn't say it was us, but it is, or at least we're one of the ones she was referring to. The majority of our fossil fuel exposure are legacies even before we went to the prior OCIO. These are investments that our former treasurer, who was acting as our CIO, had thought at the time were good investments. And we know they're running off, which is why, in fact, we are declining. So we went out to the secondary market. The discount was too severe, we felt, when you balance that we need to preserve the endowment, with the recognition that if we just let those run off within a few years, we will have dramatically gotten much closer to 0. So we're very proud, but cautious. And the lessons, just to share too, because anyone who's a little bit behind us in the process, there are lessons to be learned in that you need strong leadership of the CEO, of the trustees, of the investment committee. But also the divesting side, we're realizing, as challenging as it is, the invest is also challenging, and that was discussed today too. We need more opportunities that can meet the market-like risk and return objective. There are more stories that are giving us hope, and we're starting to make progress on those. And just two anecdotes that really make us feel optimistic were two managers, fund managers, that had come to us through Perella in possibilities as investments after we had made the announcement. They both were about 85, 90% of what we could be investing in with them was the good stuff. But there were these pictures of either an oil rig or a gas plant over here. And after discussion on both of those funds, we decided that we would not invest in them. Even though it was a small piece, and in particular, the gas one was actually a good story. It was converting a dirty coal plant to a gas plant. So that was not necessarily a good story, but a better story. But we, at the end of the day on both, decided not to. And initially, we all felt, ourselves, our investment committee, and Perella, that, okay, then we just don't invest in that fund, because many fund managers will not be carving out particular sections just for funds. And even though our portfolio is $850 million, we're not making that much of a difference. So I'll just wrap up quickly, but optimistically, the progress is both of these have actually come back to us. They want to be able to be supportive of what we're doing. Granted, I think the name of the Rockefellers certainly has the clout, which if that helps, then we'll certainly use it. And they've come back and will carve it out for us. So we're seeing progress. We're making more investments, both in the proactive impact investing allocation, and also, as I said, we're starting to see more opportunities in fossil fuel-free investments too. But that's what we need. So those of you who are investment managers, that's your job to bring them to us.
And if I might add something from our experiences at our foundation from going through this process, and I believe this is true with Rockefeller, the process has enlivened our foundation in a way that engages our board now in investment discussions in ways that they hadn't in the past. The investment discussions were often just a tedious thing that had to be done. And now it's one of the most exciting things at our foundation. And now our program staff, for good or for bad, are also involved in our investment committee. And we have really robust exchanges about what we're attempting to do. And it's an energy shot, actually, to the foundation.
That's actually a really good point. The same thing is happening at our institution. And the investment committee and the investment manager are learning so much from the program teams. They actually ask the program teams sometimes, especially the climate change folks, well, what do you think of this? And do you know these people, et cetera? But also, it's really given the program staff such an education and sort of a reality check in that, yes, as I explained, you can't just turn off a switch and get out of all the bad stuff immediately. And we've actually invited them to some of the investment committee meetings, and they've heard these really thoughtful conversations and walked away and realized, wow, they're really working hard on this. They're not being stubborn. It's tough. So we have to understand that and work with them, and then take the calls when the investment manager does want to pick their brain, which is really very helpful.
And so that's a good segue to introduce Tom Van Dyck, who is the founder of the ESG group at RBC. And Tom, though, I think is renowned for his leadership in the socially responsible investment field and his history in the socially responsible investment field. And Tom is also managing portfolios of clients, including ours, I must say, who have committed to divest and invest. So Tom, do you want to give the group a little bit of the overview of the mechanics of a commitment to divestment and investment in your portfolio and the financial case for investments in new energy solutions?
Thank you, Ellen. And I think, Jerry, thank you for those comments. Hopefully you're engaging while you're doing your divestment as far as participating along Mark's lines of promoting the idea of holding these oil companies accountable and getting them to turn into yieldcos, essentially, by paying out. That's essentially gives the executives incentive because they get paid off. Essentially, they get benefited. That's the only way the board and the executives are actually going to do anything is if they end up getting some coin for making that kind of move. But the biggest opportunity that's taking place, actually, is this idea of the transition of our economy from a petrochemical molecule to an electron produced by sustainable measures. And I think Stephen Hines, actually, the day of that press conference, said something that was really prophetic. They said, how can you, as Exxon, you founded Exxon, how can you be divesting? This is where your money came from. And Stephen said something that stuck in my head from that day. He said, he goes, J.D. Rockefeller was an entrepreneur. He saw that we couldn't keep harvesting whales to produce whale oil to run our economy, that we need to start drilling for oil to do that. He said, if J.D. Rockefeller were alive today as an entrepreneur, he would say, we cannot be drilling for oil anymore. We need to be moving to more sustainable sources powered by wind, solar, and more efficient means. And that's what we're about to enter, is the largest economic opportunity of our generation. Whether this is a huge opportunity. You can choose not to participate, but you're going to miss the returns. And it's not just moving into wind and solar, as an example. It's going to be across the entire economy. It's going to start with building, lighting, insulation, HVAC. It's the area of waste reduction, recycling, becoming more efficient. So that you can start hearing a trend here. What you have is this is about an economic argument because things are more sustainable and more efficient if almost we follow the powers of nature by what's out there rather than polluting, which essentially pollution is a subsidy in a free market. Agriculture, huge thing, organic, food reduction, water. We obviously know in California that's a huge issue with infrastructure build-out. Energy, so not only solar, wind, absolutely, energy storage. We talk about battery power as being like the game changer from a utility perspective. Transportation. Ira's going to get into that. He sits on the board of Tesla. As we move from a petrochemical molecule to that electron in the area of transportation, it's going to be huge, and the shift in the opportunities are going to be massive, economic-wide. What you're beginning to see is what you have is, in an oil company, in the fossil fuel companies, you have a commodity industry where the pricing goes up and down versus a technology industry. Who wins when you have technology versus commodity pricing? Technology. Why? Because they become more efficient and the cost gets lower and lower and lower. It's like Moore's Law. They can't compete ultimately. And what we're about to see, we're at an inflection point now where the cost of solar and electrical generation is so cheap and getting cheaper. It's at grid parity right now in 18 states. It'll be a grid parity across the entire United States within the next few years. Right here, this chart shows, the bar shows the drop of solar from 2007 from $3.80 a watt to 70 cents a watt in 2013. It's actually 60 cents a watt now. Daunting, crushing from the perspective, the adoption rate is going up. The same thing's true in offshore wind. Look at the drop from the perspective of innovation coming in place over time and the adaptation, because it makes the most economic sense. This is about economics and sustainability. LED lighting. Look what we can do now. We can light these rooms with 1/10 of the energy that we could 4 or 5 years ago, and at much less pricing. The holy grail, right here, battery storage, okay, is the holy grail of transition. Look at the drop that's taken place just since 2009. I was talking to Jim Rogers a couple days ago at the US CIF conference, and he's like, battery storage is never going to work on the big scale. I was like, really, Jim? What price would you need it to be at before it would be feasible to do large storage? He's like, $200 a watt. Ira might be able to answer the question as to where that battery plant, the gigaplant's going to be in 2017, though I think that's a trade secret. But my guess is it'll be below $200 a watt. So once we get this, the reason battery storage is so critical is because it can mitigate the fluctuation, and you have baseline storage now, baseline power, that can replace the fossil fuel industry from the standpoint of producing that for electricity. That's why it's significant. And there's lots of ways of doing battery storage. It can be lithium-ion, and Ira can get into some of the technology. Let's talk about how much money has been going to this sector. We heard $1 trillion. It's gone from, in the last 10 years, $60 billion to $310 billion in assets that are being invested across the area. And this is just clean energy now. So we're going to go straight into the clean energy area. 16% increase over the last year. Hasn't hit the peak that it did in 2011. Where is it going? It's going into wind. It's going to solar, half of which, $74 billion, is in rooftop solar. Microgrids. Why is that important? Job creation. Creates more jobs by doing microgrids, because guess what? It's all 50 states. You just don't need to be in a state that has shale gas or has oil. It's all 50 states. It's ubiquitous. The emerging market uses more oil and fossil fuels than anybody else. You can now you don't need to build a grid and an infrastructure to power these areas. You can actually use solar and battery storage, much more efficient from that perspective, much more economical, much more sustainable. So microgrids, jobs, national security. Think about that. National security. The biggest risk, as was talked about at a series conference by Jim Woolsey, who was the CIA director, to our national security is the grid. Okay? A tree fell down in Ohio and took down the entire east coast of the grid, all the way to Toronto, all the way to New York. Remember that? Almost melted down a nuclear power plant in Ohio. That's a tree. That's an unplanned disaster. Okay? Think about if they actually try to hack into it, and which is they're attempting to do. If we have microgrids, it's a much safer national security perspective. So you get jobs, national security. The other side of the coin is the demand side. What are the large users of electricity doing? Apple, all the cloud guys. Apple, Amazon, even Walmart, Costco. What they're doing is, because they have huge electrical costs, the price of electricity, last I looked, we'll go right here quickly, is still going up. Okay? The cost of solar and wind is going down. So what if you just say, well, I'm going to go set up a solar farm over here in the desert or somewhere near the grid, and I'm going to that's going to be my power source now. I can lock in a power purchase agreement with a solar contract at 6 to 7 cents a kilowatt hour for 20 years. Ask a CEO of a fossil fuel company, natural gas or coal, if I can lock in a power purchase agreement for 20 years to buy their natural gas for the next 20 years. They'll look at you and say, are you crazy? We think nat gas is going to be at $5, $6, $7, wherever. It's not going to be at below 3. They can't sell it to you. If that's a big cost of business for me, if I'm a business leader and that's a big cost, I want to lock in my costs. That's why you're seeing these companies make these contracts in solar and wind to lock in and lower those costs. And it's happening all over the world. Everyone's doing it. China's a big leader. We can thank China for the $30 billion to help bring down the cost of solar, actually. They're going to do 20 gigawatts of solar this year. We're going to do 15 gigawatts in the next 2 years. So with that, I'm going to punt it to Ira, who's got some ideas. And maybe, Ellen, you want to introduce him, but some of the ideas that Ira has been investing in directly to give us some of the solutions.
Real quick, because we're running out of time. Ira, Tom, thank you. Ira Ehrenpreis is a renowned clean tech VC, and you have his bio, but I would like to just ask you, Ira, if you direct your questions or your comments towards some examples from your own experience of investment opportunities in the new energy solutions, and I know that you will offer us some rich historical experience.
Well, first and foremost, I just want to thank and congratulate Ellen on all the work you've done, and we all wouldn't be here without you, so I want to start by acknowledging and congratulating you. Thank you. I also really do want to thank Tom, John, and a bunch of others in this room and beyond who've been big supporters of us and what we're doing, and others like us, to really stimulate what we're talking about here as not just a way to change our world and our climate, but really, as Tom said, to really move into this incredible financial opportunity. And that really is the heart of what our firm does and invests in. We're called Double Bottom Line Partners, DBL. I partnered with one of the renowned impact investors, Nancy Fund. And our view, much like what we've been talking about and much like some of the commentary that Tom gave, is this is not about trade-off. This is not about, can we find financial opportunities in order to serve that second bottom line mission. This is all about identifying what we think of as one of the truly great financial and economic opportunities of our time. We've been fortunate to have partnered with some of the great entrepreneurs to date in the sector, Elon Musk, Lyndon Rive, and a number of others. And I think they're a foreshadowing of the kind of entrepreneurship that we're beginning to see in the sector, but we're really in the infancy of it. We look at this a lot like any of the cycles of innovation that we've seen over the last century. And when you trace some of the skeptics and some of the cynicism that we've seen historically in any of the other cycles of innovation, we went back to when there was a horse and buggy to automobile transition, the advent of the light bulb, what people said when television was first discovered, of course the mainframe skeptics and what they levied against even the possibility of a PC unfolding, and of course we all know what people said about a dozen years ago when the dot-com bust happened, how the internet was overblown. You know, as investors, what we need to do is identify these opportunities before the rest of the world sees it. That's when we can do our best. And in every other historic example, those who actually understood the transition and the changes that were happening before their very eyes and didn't get stuck in the historic roots of incumbency were those best rewarded. And that's precisely where we are now. A dozen years ago in Silicon Valley, when the dot-com bust happened, most abandoned ship. Most said it could never be what people thought it was in those early days of the internet. And because Pets.com happened, most investors missed Facebook, LinkedIn, Twitter, and all the rest. And that's exactly where we sit today. There's been a politicization of companies like Solyndra. We happen to be part of a company, Tesla, that is about a mile away in Fremont, that is now the largest auto plant west of the Mississippi. When GM shuttered that plant about 6 or 7 years ago, the job loss was devastating to that community. And now the revitalization as a result of that success, and it's extraordinary to us how still people will talk about what is 1 mile down as opposed to really what's happening and not the past. When you look at the specific companies and opportunities, you know, some examples here, I think Tesla becomes in many ways a microcosm for what we're talking about here. When we invested in the company, people said to us, but there hasn't been a US auto OEM IPO in over 50 years, Ira. How can you invest in a little upstart here? And of course, the big auto companies had very, very large R&D efforts to do an electric vehicle. And yet some radically different thinking. In this case, it happened to be around the form factor of the battery, the storage, the 18650 that was going to be used, that had been used in laptops, and how we created a thermal management system to ultimately be used in an automobile was a very, very different kind of approach to power and EV. It is one example how different thinking, how entrepreneurship can overhaul what is really a century of incumbency and a lack of change. And in that case, through a lot of hard work and tenacity by that team, who I have deep respect for, they just challenged every assumption around an electric vehicle. At the root of it, though, was not to make the best electric vehicle. That is not what Tesla's mission was. It was to make the best vehicle, the best car. And it turns out, now about 7 or 8 years after the early days of that company, they've won the Automobile Magazine Auto of the Year Award, Motor Trend's Auto Award, Consumer Reports rated it the best ranked car in the history of Consumer Reports rating passenger vehicles. It now has market cap a little over half of GM, about a 30 billion market cap right now. And that team has shown how different thinking and how entrepreneurship can radically change an incumbency world. Lyndon Rive at Solar City, when he started to, he had been an entrepreneur focused on software and identified energy as the next great frontier. And there were a lot of skeptics and cynicism around those early days at Solar City. Today, as Tom described, you know, you've got, I think it's now more than 20 states here where you've got not grid parity, but grid superiority, where every one of Solar City's customers today who had been with a monopolistic utility with no choice as to where they got their energy, today as a Solar City customer is paying less for their monthly bill as a Solar City customer than they'd always paid. And so the notion was not just that it's good, better for the environment, but now every one of those customers, it is cheaper for them. The notion of trade-off has gone out the window. These are not people, unlike 10 years ago, when you look at Tom's cost curve chart around what the cost of solar is, today we're at a point where people can do this, and it's no longer the or. It's no longer whether you can focus on the financial side or the environmental side. We are in a world of and. It is not in the future, it is today. You don't have to decide whether to drive a golf cart or a car that's great for the environment and fast and an iPad on wheels and the highest safety rated car in the history of NHTSA. It can be both. You don't have to have something powering your home that is great for the environment and pay more, because today you can do that and pay less. And there's a set of examples around that, and it's largely from where I sit, we are merely serving the entrepreneurs that we're fortunate enough to walk into our doors and who want to partner with us. And if anyone asks me what I am most optimistic about and why I'm so optimistic about why the next several decades of opportunity are going to unfold around what we're talking about, it's because of the human capital side. You had a guy who was running PayPal a decade ago, who today is running Tesla and chairman of Solar City. You had Lyndon, who was running a software company sold to Dell a decade ago, today running Solar City. You have Bill Watkins, former Forbes CEO of the Year, running Seagate, king of data storage, today running an energy storage company. And the list goes on. That's what we see day in and day out in our office. And that's why we think that these examples, which are in the early days, I always say first pitch of that first inning of the first game, of not just a 162-game season, but a first century of games that are going to be played around energy innovation, that's why we ought to be optimistic.
Thank you. Ira Ehrenpreis.